Japan is a gold mine for value investors. Now, 12 years ago, it was the gold in those mines was fool's gold because you were never going to get at it. But now there's a reasonable prospect, if you engage with companies, that they will put into place a strategy to unlock value.
Welcome back to Breakout from Breakingviews, brought to you by PGIM. I'm Peter Thal Larsen, the global editor of Reuters Breakingviews, and I'm joined this week by Edward Chancellor from his study in the west of England. Eddie, welcome back. Good to see you.
Nice to see you again, Peter.
So Eddie, this week you've been looking for us at the question of Japan and the Japanese stock market. Investors in Japan have long, or foreign investors in Japan have had a very difficult time for a very long time. You think that is changing, and you think that might continue. Can you just give us a quick recap of how we got here, and then we'll talk about what's going on now.
So Peter, investors in stocks naturally require decent returns, and the historic return from the US has been around 6.5% real annual returns. To put Japan in context, between 1960 and 2019, the total return of the Japanese stock market was 0% for equity investors. Or if you want to take from the end of the bubble economy in early 1990 through to 2023, and this data comes from the Credit Suisse annual returns yearbook, that the total return was negative 0.3% over a 32-year period. So that is that's a pretty negative return, and you can understand why a lot of foreign investors gave up on Japan. However, I'm arguing the situation has changed dramatically. And there are two aspects to it. One is really a macro story, and that was that the poor returns in Japan came from a combination of high overall valuation of the market. Japanese market was at 80 times earnings in 1990, but there were some other factors. There were the long period of corporate deleveraging as companies were massively over indebted, and that lowered returns on equity. And then deflation in Japan that lingered for a long time compressed profit margins. And you put that together, and I think that explains why you had the very poor returns up to just over 10 years ago. And but the deflation has gone and the deleveraging is over. And actually, Japan, since 2010, has delivered perfectly respectable returns of 7.5% real per annum. So in fact, actually, you could say nothing particularly wrong with the Japanese market in recent performance. But more important,
there has been this shift, though. I mean, you talk about the macro effects, and obviously there's been the Bank of Japan has thrown everything at the kitchen sink at trying to end deflation and get things going. The currency is obviously devalued quite a lot. But the other complaint that was always made about Japanese companies was that they didn't listen to their shareholders. They cared about their employees, and they cared about the government, and the shareholders didn't really have any power over the companies. So, but that seems to be changing as well.
Yeah. So, corporate Japan cared about stakeholders, and in fact, I once visited a Japanese company, and on the wall they had what they posted to what they called the 5 joys, and the 5 joys were those who the company was serving. They were the employees, the suppliers, the customers, the greater society as a whole, and last and least were the shareholders. And back then, if you came along, you're a foreign investor, you see there were so many of these so-called net companies whose market value was actually below the value of the cash and working capital on the balance sheet. So that screams value to you. And foreigners would come along and they'd say, we'd like you to do this with your cash, or we'd like you to divest these securities. And the companies would just rebuff them, turn them away. And they say this type of activism is very anti-Japanese. And what I'm arguing in the piece is that actually the policymakers are now driving for change, and that's coming from on high, from the Ministry of the Economy, Trade and Industry, the METI. It's coming from the stock exchange as well. It's also coming from the Japan pension fund. All of what they're pushing for, what METI is pushing for, is it wants Japanese industry to consolidate. Notoriously, as I mentioned in the piece, Japan has 9 car makers. I think it has 13 printer manufacturers. I don't know how many fridge makers it has. So Japan realizes, the policymakers realize that they need a more consolidated industries to compete on the world stage. And this is a key point for investors, is they require the shareholders to drive the change. And what that means is that METI wants a market for corporate control developing, as you have in Europe and the United States, and they want the shareholders to drive that consolidation.
So there's big changes afoot then in terms of sort of corporate. The wheels are grinding, companies are shifting. I mean, as a foreign investor, there's the other thing to consider here is currency, and obviously the yen has been weakening quite a lot because interest rates in Japan are still very low relative to other parts of the world. What should people expect there?
So the currency, I spoke to some people last week in Japan. They say the currency is startlingly cheap. The Japan clothing manufacturers apparently last week announced that their costs were lower than Bangladesh. A Big Mac in Tokyo costs a Big Mac meal costs $2.88 in Tokyo, and in Alabama the same Big Mac meal costs $7.50. Apparently Tokyo is just crawling with foreign tourists. It's just so cheap at the moment, and with the and as one of my contacts said, Japan is now the Mexico of Asia. I mean, no one would have believed that. And the last thing that one should bear in mind is valuations. I've just mentioned that half the market is trading below book, but on a on a sort of cyclically adjusted price earnings ratio, Japanese market is about 18 times. And you compare that to United States, which has been trading about, around 30 times, probably just a bit under 30 times, given the market weakness in recent months. So the Japanese market is a great deal cheaper. And as one of the people I spoke to says, Stephen Codrington, the research analyst, he says, Japan is a gold mine for value investors. Now, 12 years ago, it was the gold in those mines was fool's gold because you were never going to get at it. But now there's a reasonable prospect, if you engage with companies, that they will actually will put into place a strategy to unlock value.
I see. Well, and I guess if you're an investor in Japan at this point, you're also in good company because Warren Buffett is also buying Japan. So
yes, but can I just, the last point, Peter, is that, as I say in the piece, the international investors, active managers are still underweight Japan, and I think they're making a great mistake. My former colleagues at GMO produce 7-year forecasts. The forecast for small cap value in Japan, if you throw in the expected currency appreciation, is around 12.5% real per year. GMO's forecast for US equities over the next 7 years is negative. So you put that together, and if you think this is crazy, GMO had roughly similar disparity of forecasts between emerging markets in 2000 and the US market. And over the next 10 years, the US stocks were flat and emerging markets did staggeringly well. So if you will, Japan is really in the position that emerging was when it started its great bull run in 2000.
Okay, well, it's good to have a strong view, Eddie, as always,
and a positive view,
and a rare positive one. So on that note, thank you very much, and we'll talk again soon.
Okay, Peter, thanks.